Here at Mir Finance, we have a lot of Chinese friends, and we really find the Chinese way of thinking and living extraordinary. But the question always begs, why China's booming economy is not reflected in the stock market? So please accompany us to see why that's the case. Don't forget to subscribe before. So the Shanghai Stock Exchange market has delivered in the last 35 years of our analysis very mediocre results. Here is the graph of the index. As you can see, 2008, big peak, which we still haven't even seen. And we still haven't seen the 2015, 2016 period of big inflows. And here we're going to present the information compressed. So we divided by 3 different decades, actually 4, half of this one. You can see the boom in the decade of the 90s, total return of 970% for the Shanghai Stock Exchange, annualized return of 26%. Usually the S&P 500 delivers 9%. But your average GDP growth was 10% that decade. And then you see from the 2000s until now, annualized return in the 2000s, 4.7%, but the average GDP growth actually went up 10.3%. So big disassociation between both. You will think as an economy grows, its index of the stock market also grows. And then in the 2010s, flat 0.83%, I'll get more money in my bank account. But the average GDP growth still extremely high at 7.3%. And then this decade, actually negative 0.71%, while the average GDP growth is extremely high still at 5.5%. So what's going on here? Why does the stock market don't follow corporate profits, don't follow economic booming? You will think more inflows mean that also it goes to the stock market. Well, there's 3 factors. The first one, the involution, is price wars. We also have restrictions on foreign investors, which of course remove a lot of liquidity and a lot of inflows. And the third one is the low local participation in the markets. So let's do the most complex one, which I found fascinating. That is the price wars. So Chinese companies differ from the European and the Australian or Latin American or the US because they don't focus on maximizing returns to shareholders. We always joke about it that finance in the US is just maximizing returns. And to do that, you either sell more to get more revenue and then you lower your costs, so your profit margins increase. But in China, it's the opposite. It's minimizing profits so you can kill your competitors. And how is this? So this is just the supply chain that a lot of countries are following. Everything starts in China. You sell the raw materials, your ideas, your intellectual property. Then maybe, as a German company, you need to make some changes that you can only do in Poland. So you send it to Poland, and then you brand it out in Italy. So actually you get everything back to Germany, but everything starts in China. So whoever has the idea of sending everything to China is going to be rewarded in Germany because it dropped the cost of manufacturing the product and it can increase profit margins. However, this is what happens. So Germany is selling, let's see, a device that is very unique, manufactures it in China, and then sells it to the world for $8,000. Well, at some point, after a decade, the Chinese decide that they don't need the Germans anymore. They know how to make it themselves. So they cut it to 950. And why so low? Why not go with the Germans? Be like, all right, we want some participation. Let's just bring it down to 6,000. Because 6,000 still takes a lot of the competition out and our profits are fine. Well, the Chinese don't think like that. They just want to completely reduce the price to kill competition. But before the Germans have established a relationship with the Chinese counterparty, the Chinese already have killed each other, common quote, of course, in the economic sense, internally fighting for the production. They just China just wants to lower and lower cost. It's in their DNA. This is what happened. This is just how supply works. You have a cost of production and you want a desired profit. It varies by industries. It varies by the product. Some products have a more elastic or inelastic supply, but this is just the case. Well, the Chinese just want to drop from P0 to P1 because they want to bring your cost of production, your desired profit, very close to your cost of production. They don't care. So they take Germans out, then they by also taking their competitors out. And then the most interesting part is they actually take themselves out. Not out, but they just lower their prices even more. So even after you took the Germans out, you took every competitor out, then you also drop your prices because it's in their DNA just to lower and lower and lower prices. It just look something novel. So of course, stock markets don't function like that. Stock markets function that you expect a company to improve margins, to improve in revenue, right? So your enterprise value is very correlated to your profits. But if your prices keep going down, your revenue will go down, even though you get more market share. Still, the volume that you have to sell at a lower price might not equal the same to keep your profits up. So if your your enterprise value goes down, your stock market will go down. And what happens is, as companies in the US or Europe or in other places want to compete with China, they basically have to bring their marginal cost basically down to a point that is really costly for companies to enter the market. So in another sense, your profits have to be too low that the Chinese are like, all right, we won't make any profit because we don't know how to improve our cost. But Americans don't function like that. The Westerns don't function like that. We don't function in lowering cost. We function in increasing our revenue by marketing it better, by improving the quality, by increasing territory, by making bundles. Of course, cost is important, but that's not our factor. Our factor is to increase that profit by doing all the marketing and all the improvement and the quality and the innovation. So we cannot compete like that. The United States cannot compete like that with China in trying to lower costs. That's where Donald Trump's tariffs come to place, and that's kind of makes sense from his point of view. That when he increases tariffs, he's basically deterring the Chinese to compete in our markets because they are ruthless in price wars. So with the tariffs, they basically, what Trump is doing, take them out of our market. So it's very interesting how they work. And also the second reason is the restriction on foreign investors. Although they have been opening more and more, but foreign investors only hold around 5 to 6% of the market cap in the stock market in China, so there is not too much inflow. And also there is a concern in data transparency, so the reduction in the ability of certain economic data, which might impact investment decisions, so foreigners are not too keen of investing there. And the other part is the low participation. Only 23% of the households are invested in the market, which of course lowers liquidity. In more developed markets, you have participation rates above 60%. So let us know what you think. Very interesting how the Chinese mind works, and how they keep innovating, but lowering price. I think in the Western culture, we always want to have the bigger house, the bigger car. I think in China is how can I reduce my cost so I can really mass produce everything. So let us know what you think.